Today, we're diving into the world of economic indicators. These are like the heartbeat of an economy, telling us whether things are booming or, well, heading south. But don't worry, we're not diving into a textbook. This is a fun, quick look at three main indicators: GDP, inflation, and employment rates. By the end, you'll see how these numbers impact your wallet and maybe even the world around you. Let's kick things off with the big one, GDP, or Gross Domestic Product. Fancy name, but all it means is the total value of everything made in a country. Think of it like a giant pizza. The bigger the GDP, the more pizza there is to go around. And if GDP's growing, that's like adding extra cheese. So, why should we care about GDP? Well, it tells us whether a country is thriving or struggling. When GDP is up, businesses are usually thriving, and people are spending. When it's down, it's time to tighten our belts, and let's be real, no one loves that. Now, meet GDP's tricky cousin, inflation. Think of inflation like a balloon. It rises, things get more expensive. Inflation up? That's your grocery bill skyrocketing. Suddenly, that bag of chips you bought last week costs as much as your first car. Central banks, like the Federal Reserve, keep a close eye on inflation. If it rises too fast, they might raise interest rates to help cool things down. But if it's too low, the economy might look a little sleepy. So, just like that balloon, you want inflation to hover at the right level. Not too high, not too low. Next up, employment rates. This one's a big deal because it shows how many people are working and earning. A high employment rate? That's a good sign, like a full house at a concert. More people working means more people spending, which is great for the economy. But when unemployment is high, it's a signal that the economy's having a tough time. People aren't earning as much, which means less spending and more stress. And nobody wants that. So, how do GDP, inflation, and employment rates work together? Imagine them as roommates. GDP is the one who earns money, inflation is the spender, and employment rates are, well, the busy worker trying to keep things running smoothly. If one of them goes haywire, it usually throws the whole economy off balance. These economic indicators are powerful tools. They help us make sense of why prices are changing, why companies are hiring or laying off, and where our economy might be headed next. Understanding these basics isn't just for economists. It's for anyone wanting to be smart about their financial future. This was just a quick overview of these economic indicators that are so important to us. If you want to go deeper, check the link on the description for the whole article and more at wealthjourney360.com. Thanks for watching. Be sure to hit like and subscribe for more. Stay tuned. Level the game.